Hello everyone, Finance Car Guy here, and you might be asking yourself, well, your name is called Finance Car Guy, but you're not in the car today. And the reason I'm not in the car today is because I didn't go to work today. And well, it's not that I didn't go to work today, I'm actually working from home, and I thought during my lunch break, what better time to film today's video? So today's topic that I want to talk about is stocks, ETFs, and mutual funds. Now, what I'm going to be doing this time instead of reading directly from my phone is I have some notes here off to the side. So if you see my eyes sort of going between the viewfinder here and also the computer screen, you know exactly why. I'll also be overlaying, like I always do, some extra information so that way you can keep on track with me and you can just learn more as we go. So I hope today you guys like the format. I'm going to be going on vacation for the next 3 days. The videos are not going to stop, but you're going to sort of go on a journey with me through different settings. So I think that's going to be a lot of fun too. So without further ado, let's get right into it. So let's talk about a stock. I happen to think that the stock is probably one of the most, let's say, famous ways that new investors or experienced investors can invest in. I'm not sure exactly why that is the case. Maybe the stock came first before things like ETFs or mutual funds, and maybe that's a topic for a separate video. But I think when people typically think about stocks, they think about things like specific companies, and that's exactly what that is. So a stock represents ownership in a specific company, and that's very different than you thinking you're just buying, let's say, a number on a digital screen. Nowadays we have apps like Robinhood, Fidelity, Schwab, Vanguard, and instead of back then when a lot of this was done via paper, now we're looking at a phone screen and we're just looking at the price. But what I really want you to focus on is the ownership of this company, okay? I don't know what book it was exactly. Maybe it was Simple Plan to Wealth or the Little Common Sense Book of Investing or maybe even Value Investing, some of the books that I've read. But one of them mentioned how instead of you as an investor focusing on the price, think of it again as ownership in the company. I think when you look at it as a price and you see the market fluctuations up or down, we tend to get a little bit emotional about this. And I think emotions are not really good when it comes to investing. And if you also think that you're taking ownership in the company, then you feel like you're part of this company. Whether it does good, whether it does bad, you feel like you, as a shareholder, get to sort of learn more about the company. You can even be in earnings calls when you're a part of these types of companies. And I just think it gives you a little bit more, let's say, maybe a sense of identity. Because I think, especially when you're doing individual stock picking, it's very important to know exactly what you're buying. So, examples of stocks, let's say Apple, Tesla, Microsoft, Home Depot. I myself have Tesla, Microsoft, and Apple, and I've been holding on to them for many years. But frankly, when I first started investing, I didn't really know that when you buy into a company like this, I should do the due diligence. I should do the research. I just sort of bought and hold and held. And frankly, when I first started at 24, I didn't really have enough money, so I don't have that many shares, but I still kept them around because if anything, the past shows and the current future and the present show that these are probably good companies to hold. Okay, so like we already said, when you buy stock, you own a piece of the business. And now we're going to go a little bit into some of these key traits. Okay, so of course, you profit if the share price increases, but just like you can profit, you can also lose a lot of money. Okay, your risk is tied exactly to that company's performance. And that's one thing you have to be very careful with when you're investing in stocks. Unlike some of the other, let's say, vehicles we're going to talk about, ETFs and mutual funds, where you can get a basket of funds to increase diversification, a stock is a single company. So if Apple does really well, you're going to suffer. And if Apple does really bad, you're also going to suffer. So make sure you keep that forefront, at least right in the forefront of your mind when you're investing in these companies. You don't want all your eggs in one basket, else really good things can happen, but really bad things can happen too. Now, one of the cool things is you can buy and sell shares of this stock easily on the market during market hours, which I believe is 9:30 to 4 p.m. So you can do things like place market orders, you can place limit orders, you can place stop loss orders, so on and so forth. And again, maybe these types of orders are a topic for another video, but anyway, we'll get to that later. And the good things about these stocks are there's also no management fees. You're directly investing in the company, so you don't have to pay for, let's say, someone to manage the money for you. You yourself can go into these brokerage platforms like Robinhood, Fidelity, the ones I mentioned earlier, and you can invest in the money yourself. Now, this type of stock is best for investors who want to do heavy research and pick individual winners. Okay, so I'm going to follow up on something very important right now that I think is very important to understand about stocks. By the way, I am in my house, so you might hear a little bit of dog activity in the background. You just saw my golden retriever Sawyer there, which you may have seen in an earlier video. You might also hear some footsteps on the floor from a dachshund, and he might be jumping on the sofa behind me. But anyway, For the people that don't really want to worry so much about price fluctuations, having to read all the different sheets and overviews that a company has to do, which frankly I don't even know too much about. And again, I've said this 3 times already, might be a topic for another video as I start learning more about this. But if you're someone that wants a little bit more of a hands-off approach, I don't think stocks are the right move for you. Because if you don't know how to pick them and pick them right, and it's not just about following, your favorite subreddit like Wall Street Bets, or following someone on Twitter and just doing exactly what they say, you really have to have conviction in these companies. But let me give you a story, and actually before that story, let me give you a warning. So I'm going to read this directly off of here. So over 85 to 90% of actively managed funds underperform their benchmark, like the S&P 500, over 15 to 20 years. In the US, large cap stocks, the category that most investors try to beat, only around 6 to 10% of managers consistently outperform the index after costs and taxes. And this is a key point here. These are professional fund managers with full research teams. Individual investors do even worse statistically. So you can imagine the people that are the best of the best at the top of their league, the best degrees, the most years of experience, they are still underperforming the benchmark like the S&P 500. And this is why very famous investors like Warren Buffett often advise for new investors and even experienced investors that they'd be better served by investing in something like an index that tracks the S&P 500. So you have broad diversification and you have low expense ratios, things that we'll get to in a little bit. But just keep that in mind. It's very hard, and oftentimes it relies on a lot of luck to pick individual winners. But that being said, I want to give you a funny story that some of you may know about. So a long time ago, this was right before COVID started, or maybe around the time that COVID was already a thing. Somehow, some way, I landed on this article that I'm going to pull up on the screen right here because I want to tell you exactly what it says. It's about GameStop and the whole rally that went on through COVID. Now, you might remember some people on Twitter. I think their name is Deep Fucking Value, this person that really did deep analysis on Twitter during this GameStop craze and made people a lot of money. Some people really benefited off GameStop. Some people became millionaires. I did not become a millionaire. If I did, there will be signs, right? That's what people say. But I did win a little bit of money, at least $2,000 to $3,000. And saying winning is kind of weird because it's almost like I gambled, which at that time in my life I did. So there's this article that came up. I'm going to read it right here. It's from Fox Business. It says, GameStop's new billionaire investor pushes for digital sales and fewer stores. So it says Chewy and co-founder Ryan Cohen holds a nearly 10% stake in GameStop through his investment firm RC Ventures LLC, is pushing the company to conduct a strategic review after he says private talks with the board yielded little progress. Mr. Cohen, who first disclosed a position in GameStop in August, holds a stake valued at roughly $79 million based on current trading levels. Now, mind you, this was November of 2020, right? I'm going to continue on with the article. It says, in a letter sent to the company's board, Mr. Cohen said GameStop's brick-and-mortar-centric business model is outdated and lags behind the broader industry. He is urging the company to reduce the number of physical stores, focus on improving e-commerce, and explore other tech-driven opportunities in areas such as esports, mobile gaming, and game streaming. So when I read this for the first time, all of a sudden I said, oh man, it sounds like GameStop really wants to get on board with this whole digital age, and I thought that was a good thing. So at around the time that I invested, the share price was like $2, and I invested $1,000, so I got about 500 shares. Fast forward a couple more months, in just March of the next year, so March of 2021, the share price had gone up to about $33. And later on, even more so, I think the stock peaked at around $400 something. And this is what happened. The stock was at 30. A couple weeks later, I go to the dentist office and I see on my Fidelity account the stock going up and up and up. And I knew it's one of those things where like, I better sell now to lock in these gains. And I did. I sold around 70 something dollars, profited about $2,000 to $3,000. A week later, or maybe even 2 weeks later, it went to that 200 plus mark. Okay, this is something very important. Hindsight is 2020. You just want to be able to lock in your profits and be comfortable with the fact that you did actually profit something. Even if it's 1,000, 2,000, 3,000, you still profited, you still made money. You didn't lose any money. Obviously, some people got very lucky and they became millionaires. Some people like me, maybe they made less, but even worse so, some people lost a lot of money. And it's why putting all your eggs in one basket, let's say like GameStop, for example, could lead to very bad results. So you often don't want to follow trends. You don't want to go again on Wall Street Bets or follow your favorite Twitter investor. Try to do due diligence, learn the company, and if it's a company that you really have strong conviction in, then I would advise you to do individual stock picking. But I think we covered a lot about individual stocks. Hopefully that was a nice brief overview. Now let's go into probably my next favorite thing here, which is called an ETF. It's an exchange traded fund. So an exchange traded fund, you can think of it as a basket of money stocks or bonds that trade on an exchange, like a single stock, okay? For example, VOO from Vanguard holds hundreds of companies in the S&P 500. Here's the definition of what an exchange is. So, in trading, an exchange is an organized marketplace, either physical or digital, where financial instruments like stocks, bonds, commodities, and derivatives are bought and sold. Frankly, I'm really only too familiar with stocks and bonds. Again, for the fourth time, commodities and derivatives. Maybe a topic for another video, maybe a two-part series. We'll see. Comment, subscribe, and follow me to learn more about all these different financial things that I'm learning about, and hopefully I can teach you more on. So, examples of common exchanges, probably the most popular one that you've heard of is, of course, the New York Stock Exchange. Then you have other ones like NASDAQ and the London Stock Exchange. So now let's go over the key traits of ETFs just like we did with stocks. So some of the key traits. Number one, offers instant diversification. One ETF can give exposure to hundreds of companies. So one really cool thing that you can do is you can go into your favorite ETF and find the actual positions that you're looking into. So I right now on the screen, I'm going to look up SCHD. This is the Schwab US Large Cap Growth ETF. And if I go on their website, I'm willing to bet I should be able to find the exact positions they have and the percentage of each position that is in their holdings. And I think this is something good to know. This is like level one of becoming a more savvy investor. You're not just now investing in some ticker, right? You're like, oh, I'm just going to go on SCHG because everyone tells me. Go and find the things here and find exactly what it is you're looking for. So on their website, I'll have this on the screen too. I clicked on a tab called Portfolio, and from here I can see their companies. So they have 11.35% into Nvidia right now, 9.79% into Microsoft, 9.57% into Apple. So you can see we have a broad set of different individual tickers that we're investing into, right? Really, really nice diversification. You can do this with any ETF, and most funds you can do this. So I want to encourage you to get the practice in, get your hands dirty, look these up, and find the positions and the percentages and learn for yourself. The more you keep doing this, the more comfortable you'll get, and the better you'll be able to know where to invest and manage your money. Okay, one of the coolest things here is the low ratio, the low expense ratios that these funds have to offer. Typically anywhere from like 0.03 to 0.1, but let's see what exactly SCHG has and see if we can find it. So I see here price to earnings ratio, total expense ratio here is 0.04. Okay, so I actually have an example here of 0.03. So 0.03 on $10,000 is $3. So the 0.04 is $4. Now contrast that with something like 0.1 on that same $10,000, and that's $10. Now from $3 or $4 to $10, it might not seem a lot, but in some cases from 3 to 10, that's more than triple. And from 4 to 10, that's more than double. So you have to imagine over a long period of time, these expense ratios, this is the amount. An expense ratio is the annual fee that you pay to the fund manager, like Vanguard, Fidelity, or Schwab, to operate a mutual fund or ETF. It's expressed as a percentage of your total investment, deducted automatically from the fund's returns each year. So think back at those numbers, $3 on 10K or $4 on 10K or even $10 on 10K. Over many, many decades of time, these could compound to tens or even hundreds of thousands of dollars that you're paying that could otherwise be reinvested or used for investing in general. So something that you really, really want to pay attention to is these low expense ratios. Things like Schwab, which offer large diversification, low expense ratios, that's like a double win right there, okay? So another great thing, I already said, one ETF, give you exposure to hundreds of companies. You have things like the low expense ratios. These can be bought and sold anytime during market hours, just like a stock. So this is in contrast to mutual funds that we'll get to in a moment, but like a normal stock, you can go and buy SCHG at any time during market hours. So typically if I log into Fidelity, I can see the stock price changing, let's say minute by minute or second by second, every fifth second by fifth second, so on and so forth, just like you would see something like Tesla, Apple, Microsoft, etc. Most of these ETFs are passively managed, tracking an index like the S&P 500 or the NASDAQ 100, but some of them can also be actively managed. Now, these are best for investors who want broad market exposure with low fees and flexibility to trade easy. Some of the things that we just covered right now. ETFs are one of my favorite things. Recently, I started going more into SCHG because this is, it's the US large cap growth ETF. I wanted some more growth in my portfolio, so now I'm sort of in between FXAIX for my S&P 500, and I have something like the large cap growth ETF. Pretty much 50-50 right now in my portfolio. I might be changing these the more I learn, but this is what I came from in the past, where I had a lot more variety. I had a lot of overlap with the different funds, but anyway, again, for the fifth time, maybe a topic for a different video. So we have gone over so far stocks and ETFs, and now we're going to finish off with a mutual fund. Okay, mutual fund. What is a mutual fund? A mutual fund also pulls money from many investors to buy a diversified portfolio of stocks or bonds, but it doesn't trade throughout the day like an ETF. So for example, something like me where I have FXAIX, it only trades once per day, I believe at around 4 p.m. So let's look at the key traits, exactly what I just talked about. It trades once per day at the closing price, the NAV, the net asset value. So the NAV is the price per share of a mutual fund or ETF based on the total value of all its holdings minus any liabilities, divided by the number of shares outstanding. So NAV is like the book value per share of the fund. The book value means the total value of what something owns minus what it owes based on its official accounting records or books. If a mutual fund's holdings go up in value, the NAV goes up. Similarly, if it goes down in value, the NAV goes down. You don't trade at changing prices during the day. You always buy or sell at the end of the day, NAV, the net asset value. Okay, these can be actively or passively managed. Active ones try to beat the market, but like we said, when you're paying so much money for fund managers to try to beat the market, you're oftentimes going to be losing money, and you're better off doing a passively managed mutual fund or just doing something that follows an index like the S&P 500. Get those low expense ratios and just reap the money that you deserve. Okay, these usually have higher fees than ETFs, especially for actively managed ones, and sometimes may even have minimum investments like $1,000 or $3,000. These are best for investors using automatic contributions, like things into a 401k, or even like maybe you just set up a recurring automatic contribution to like a taxable brokerage account. Or those who prefer professional management and don't need to trade daily. Some people are willing to give up their money for their time. Some people, maybe like me, or like you, some of the viewers that are watching, maybe are not willing to, let's say, pour through all these sheets and look these things up, even if it takes just an hour a day, half an hour a day. They'd rather just pay someone to do it, even if it means they may not make the most, but at least they'll be probably getting something, again, even if it's not the most. So all in all, mutual funds make monthly investing effortless. They handle automation, fractional shares, and reinvest automatically, freeing you from having to manage each purchase. So in my example, FXAIX, what I hold, in this case would be like my mutual fund, and this is what I do have my monthly reoccurring investments going into. And then I have something like an ETF that we talked about, which is my SCHD. And I also have some individual stocks like Tesla, Apple, Microsoft, etc., etc. So I hope that this video was a nice introduction into stocks, ETFs, and mutual funds and what types of things that they are. Hope you learned a little bit, and I hope you feel a little more confident going into all this. I know it seems like a lot, but in reality, once you just start getting your hands a little bit dirty with some of the tools and some of the things that I showed you today, I promise you it will become a lot easier. So let's get into a conclusion now. I'm filming in my bedroom. Okay, this is the bedroom of my home, and it's pretty cool to be able to film in here. I'm excited, as always, for what the future holds. Again, these next 3 days, you're going to be sort of on a tour with me of different settings. So I'm also excited just to be able to try something new. Maybe I'll try more of like the selfie style, because this sort of tripod here allows for a more vlog selfie type of camera mount. And if anything, we're going to keep having fun here. We're going to keep learning a lot. I sure am. In the past, this is my 18th video. I have learned tons. I am a more intelligent investor now than I was when I started this video, and that's exactly what I want for you. If you feel the same, actually, well, to be completely honest, this is my 18th video of my 30-day challenge, but it's only my, I think, 8th video of my finance sort of transition to that niche. So if you want to, at the end of this, you're going to see a link to my finance playlist. Also in the description below, I'll leave a link to the finance playlist. You can follow all those, learn something from it, and then start compounding all that knowledge. And then tell me in the comments below exactly what you've learned, or maybe what you'd like to see. If you have some questions, I'd be happy to answer them. And anyway, with all that being said, I hope you all have a great rest of your Wednesday. It was so much fun making this video. Thank you all for the viewers and new subscribers, and I will see you all next time. Take care.